Good morning, everyone, and thank you for joining today's webinar. My name is Richard McDougall. I'm co-founder and managing director at Hamilton 12. Over the next 30 minutes, I want to introduce you to Hamilton 12 and our Australian Equity Income Fund. We'll keep the formal session to about 30 minutes and then open up for live Q&A at the end. If you've got any questions, please submit them as we go. There is a Q&A panel or function within the Zoom panel. So please submit those and I'll get those to those questions towards the end. Um, so before we begin, look, obviously the standard and important disclaimers. Let me just go to the correct detail here on the slide. This presentation is intended for wholesale investors only. So the information, please take that as general in nature. It certainly doesn't constitute personal financial advice. And of course, past performance is not a reliable indicator of future performance. The information memorandum is available on our website. So if you'd like a copy, please just submit a query via the website and we'll get that across to you. We will, of course, circulate these slides following the webinar this morning, and all figures I'll refer to today in the presentation are as of the end of July. With that, let's certainly get into the presentation. Here's how we'll spend the next half hour. I'll start with the income challenge, the need for reliable tax-effective income across many types of investor, and we'll look at how those main income options compare. From there, some of the evidence on why we think picking winners is so hard, which is what led us to building the strategy this way in the first place. And I'll introduce Hamilton 12, our team, and our proprietary Standard & Poor's Dow Jones Indices Index. Then the things that really matter most, I guess, performance after fees, the after-tax advantage and how that compounds. We'll look at the risk profile and how the strategy actually works. I'll cover why we believe this strategy is different and where we see it would fit within an investor's portfolio as a core Australian equity allocation. And then finally, at the end, we'll look at a clear path, of course, on how to invest in the fund. There's plenty to cover, so let's get into it. I'll start not with the fund, but with the problem it solves. And a very wide range of Australian investors need reliable, tax-effective income, not only retirees, but self-managed super funds, pre-retirees, of course, accumulators who want income alongside growth, and many other types of investors. The demand for dependable income is broad, and it's certainly growing. The difficulty that most income options ask you, they ask you to give something up. So term deposits and cash, of course, are low risk, but the returns are comparatively low and fully taxed. Concentrated bank and property income can certainly lift yield in a portfolio, but that will come at the cost of diversification and potentially growth. So the real question is not whether income matters, it's how to generate a high tax effective income without giving up long-term growth. And that's the challenge we certainly set out to solve when we started our Australian Equity Income Fund. And of course, the backdrop is moving in Australia. From July 27, the government will replace the 50% capital gains discount with inflation indexation. So growth in line with inflation is going to essentially be tax-free. And if you can combine that with a high, fully franked level of income, that's effectively the most tax-effective total return you can receive on a portfolio. We'll look at that during the presentation as well. So how do the main income options actually compare? This table runs across cash, term deposits, government, semi-government, and corporate bonds, private credit, hybrids, global shares, and domestic shares, all grossed up for a tax-exempt investor. A few things stand out. Cash, term deposits, and bonds, of course, are lower risk and liquid, but the income is fully taxed and there is no growth. Private credit will pay a higher level of income, but you give up liquidity, often transparency, and of course, capital growth. Hybrids are franked, which is great. They do carry single issuer risk, but they are being phased out by the regulator. And global shares will give you growth, but with very little income. So domestic shares are the one row that combines a competitive franked income, potential for growth, daily liquidity, and of course, full transparency with market volatility as the trade-off. It is equity risk. And that's exactly where our fund sits. It's at the bottom row, designed to deliver that combination in a managed, diversified way. And this is the same comparison shown as a picture. each bubble is an income source. Up the chart is more income yield grossed up, and across to the right is more capital growth potential. So cash term deposits and private credit are income only with no capital growth, and they sit on the pretty much on the vertical axis there. Bonds and hybrids can have some capital growth, but they sit a little to the right. And the three equity options, global, domestic shares, and of course our fund, which is domestic shares, have the most growth potential. So they sit furthest to the right. Bubble size here is liquidity. Bigger meaning easier to get your money out should you wish to access your funds. And color is intended to mean transparency here. What is the actual underlying investments of the portfolio that is delivering the income? Lighter being clearer. And a gold ring means that the income is franked. But before I show you the fund, it's worth being clear about why we built it the way that we did. And the financial year just gone actually makes the case better than I could. Financial year 26, end of June this year, was by common account the hardest year for Australian stock pickers in living memory. So the ASX 200 returned 2.8% on just price, so that excludes the income. And that's the weakest year since 2022, and certainly negative after inflation. 10 stocks really, five winners less five losers accounted for the entire 236-point rise in the index. Around a quarter of the index is now just two companies, BHP and CBA, and Cochlear fell 41% in a single session, the largest one-day fall by a major ASX stock in 3 decades. And Richard Shellback, who's an analyst at UBS, put it plainly in the Financial Review recently. He said this would have to be the toughest year he can remember for stock picking. And when the index gain really does sit in a handful of names, missing one or two of them decides really the outcome of what that might look like in the year, whether you've relatively performed positively or negatively relative to the broader market. And so most active funds underperform, and time certainly makes it worse. And that was one year that we just looked at last year, but the pattern is repeat. It pretty much repeats itself over time. It's a structural issue and it's consistent. These are the SPIVA scorecards published by S&P Dow Jones Indices, and SPIVA is an acronym for Standard and Poor's Index versus Active, and they measure active managers against their benchmarks across markets and time horizons. Over one year, a reasonable share of managers beat the index. Over 10 and 15 years, a firm majority in every category underperform. And you can see that that pattern tends to rise the further out you go. And it does ask the question, why does this happen? And this isn't just a one-off anomaly. This is actually a structural issue. And one of the reasons really is markets incorporate information very efficiently. And our view is that you use the decades of academic evidence and data to validate what is true today rather than making predictions about tomorrow. The evidence actually shows us that as soon as you introduce subjectivity into the portfolio formation process, it becomes very difficult to outperform the market. Instead, what we say is take that data and evidence and apply it in a really simple, repeatable process and watch that outperformance manifest itself over the medium to longer term. So what you're seeing here really is that as soon as you introduce subjectivity into the stock selection process, it really is quite challenging to outperform the standard benchmark. And as you can see here, I mean, if you look at the global equity category, for example, it's only 4% of managers over 15 years who are outperforming the broader market. And of course, fees erode returns that might otherwise appear as outperformance. Importantly, the longer the track record, the more skill becomes visible relative to luck, and it's those managers who can actually outperform relative to the benchmark. I do want to be clear here, though, we're not saying active management has no role. We are saying that a long horizon evidence-based building block has a complementary role to play alongside skilled active managers and advisor-led portfolios. So if consistent prediction is that difficult, really what's the alternative? And our answer was to stop trying to predict, but instead build portfolios on what we can validate today. Dividends that have been declared, franking credits that are confirmed, valuations relative to a company's own dividend stream, and diversification that is measurable. And that shift from prediction to disciplined implementation is what started Hamilton 12 a number of years ago. And so the business was actually founded in 2017. We were developed at the University of Queensland in partnership with S&P Dow Jones Indices. And we're an active manager, but a systematic one. So our flagship strategy is validated by our proprietary S&P Dow Jones Indices Index, which I'll return to shortly. And at the end of July, the fund held just over $39 million. And between the three of us, the founding team has more than 60 years of experience across academia, global finance, governance, and technology. One word on the team. My co-founder, Dr. Jason Hall, is our Chief Investment Officer. Jason holds a PhD in finance, is a CFA charter holder, and has spent more than 20 years researching dividend imputation credits, analyst forecasts, and value-based investing. He was an equity analyst at Credit Suisse, a senior lecturer at the University of Queensland, and he currently lectures in finance at the University of Michigan. His research is actually what underpins the systematic stock selection process in our portfolio. I lead investor relations and distribution, and our Chief Operations Officer, Damien Vassallo, brings 20 years of governance, risk, and compliance experience. We also have an advisory board. Those details are in the appendix. We'll circulate these slides. But the point really I want to leave with you on this slide is that all three co-founders are co-invested in the fund. We seeded this fund from day one. We are still invested in this fund and will remain to be invested in this fund. So our interests are certainly very much aligned with yours. And that brings us to the underpinning of the fund. Our proprietary S&P DJI index, the Hamilton 12 Australian Diversified Yield Index, this is not just our internal calculation. This index is calculated and published by Standard & Poor's, which provides independent institutional grade governance over the methodology, the investment methodology. There are three distinct phases. First, back-tested calculation from September 2000, applying the methodology to historical data. Second, that index went live in November 2020, and third, actual fund performance from September 2022. So on the right is the S&P's own page for the index, which anyone can look at. It's a public website. And on a tax-exempt basis, including franking, the index is compounded at 13.7% a year since September 2000 against 9.8% for the S&P ASX 200, which is the benchmark for this fund. The point is that it's rules-based and the rules are repeatable and independently applied. You don't just have to adjust or trust rather your own discretion or arithmetic. S&P have done all of the calculations. And so really that takes us to the fund itself, the Hamilton 12 Australian Shares Income Fund, which adopts the same investment strategy as the index we've just looked at. And the investment objective here is to generate long-term after-tax returns for Australian investors in excess of the benchmark after fees, which is the S&P ASX 200, including a gross dividend yield higher than that of the benchmark when you include franking. The benchmark is the S&P ASX 200 superannuation version. The key proposition is simple, really. High tax effective yield and competitive total returns. High tax effective yield, not at the expense of total return. Traditional income strategies will often trade return for yield. We are specifically designed to deliver yield and capital growth. The details are on the right. At the moment, as I mentioned earlier, the fund has net assets at the end of last month, 39 million. It's now over 40 million. There's about 120, or there are 126 holdings in the portfolio at the end of July. Distributions are not quite 100% franked. They're almost 100% franked. Not all of the names in the portfolio will frank their distributions or dividends at 100%. We pay distributions quarterly, with the next on the 9th of October. Applications and redemptions are daily, so this is a daily priced fund. You can make an application into the fund or request your funds to be redeemed on a daily basis. It's got a management fee of 60 basis points and a modest performance fee, where if the fund outperformed the benchmark all of the time, which it doesn't, that would equate to approximately 90 basis points in fees, which is the category average management fee for Australian equity income funds. So we're only earning the 90 basis points if the fund is outperforming all of the time, not just charging you a flat 90 basis points all of the time. And top right, you'll see we hold 5 stars from fund monitors, on both performance and risk over the 3-year period. And that means really the fund sits in the top 10% of 131 peer funds on both performance and for risk, which we're really pleased about. So now let's look at the fund performance after fees to the end of July this year. So over the past year, the fund returned 16.3% versus the S&P ASX 200 at 7%. So that's an outperformance of just over 9%. I want to be clear that a single year outperformance reflects one point in the cycle, and investors should consider the full term history. So what we're really interested here is the total return performance over any rolling 3-year period or longer, and ensuring that the fund is constantly delivering yield higher than that of the benchmark. And look, the strategy is certainly doing that. It's delivering as we would have expected. You can see the 2 and 3 year numbers there on the chart as well, obviously outperforming relative to the benchmark. But more importantly, what you can see there, I should have pointed out actually, so the light green bar is the fund that you would be invested in. The gold bar is really the benchmark, what we are looking to outperform. That's the S&P ASX 200. The dark green bar is the proprietary S&P index that I mentioned earlier. That's our own proprietary index, which our fund adopts the similar investment strategy. But what you can see there is a proxy for performance of the fund over the 5, 10, and since inception numbers is that the strategy validated by S&P is expected to outperform the S&P ASX 200, and our fund really just adopts the same investment strategy as our index. After-tax yield is also where the strategy really differentiates, as at the end of July on a trailing 12-month basis and including franking credits. For tax-exempt investors such as a charity or a pension fund in retirement, the ASX 200 yielded 4.4% and the fund yielded just under 7%. So you can see there that, and we'll talk about the rotational basis, but you would expect the income to always be higher than that of the benchmark, assuming companies in the ASX are still paying dividends, of course. And for a super fund, you can see there that the cash dividend is still the same, but obviously the imputation benefit is slightly less, but still outperforming the S&P ASX 200. And we also produce the results for a corporate strategy there. The reason why it does that is the underlying investment strategy, which we'll look at shortly, and that the distribution from the fund are franked higher than that of the ASX 200, which carries approximately 80% franking. Our fund, as I mentioned, is over 99% over the last 12 months and pretty much consistently since inception. So we've just seen that the fund delivers a much higher after-tax income. So what does that advantage compound to over time? Both charts here start with $100,000 for a tax-exempt investor with everything reinvested. On the left is income only, so just looking at the distributions from the fund. And if you reinvested the grossed up income, and we've just used the 6.93% here as an example, which was the trailing 12-month yield versus the ASX 200 yield of 4.39. The balance grows to about 746,000 versus 363 over that extended period. So that difference of about 384,000 over 30 years or 184,000 in today's money, and it excludes any capital growth, of course. On the right is the full total return, income plus the capital growth using our since inception returns for the fund. And there the gap widens to roughly 1.8 million or $858,000 in today's money, which is a material difference in terms of outperformance relative to the benchmark. I'm just having a look here if there's anything else to mention. No, I think that's pretty clear. But really, it's just showing that compounding is a powerful tool. And if you can get that incremental outperformance, then really that does compound to a meaningful outperformance over time. The other side of the return story, of course, is risk. Here's the risk profile of the strategy versus the ASX 200. Standard deviation, which measures the volatility, pretty much in line with the ASX 200, marginally higher, but certainly in the same neighborhood. The maximum drawdown was during the GFC for this strategy. So that's from the peak to trough. How much did this strategy draw down? This is equity risk. So this is Australian shares. It did draw down 42% versus 49% for the ASX 200. So marginally lower. But what's important here is the recovery period. So the recovery period for this strategy was just over 2 years versus 5.5 years for the ASX 200. And that is due to the portfolio constituents and the rotational basis of the strategy, which we'll look at next. The Sharpe ratio, 0.68 versus 0.46. You want a higher Sharpe than the benchmark, so more return per unit of risk. And Sortino, for those who are interested, 1.41 versus 0.84. So again, better still when you only count downside volatility. Alpha of 3.8% and a beta of 0.97. So again, a roughly comparable risk profile to the ASX 200 with outperformance there. Upside capture, 108%, you want it over 100%, and downside capture at 88%, you want that lower than 100%. And that methodology captures more of the market's upside and less of the downside. So that's what we want to see in a strategy like this. And that combination is genuinely distinctive. So risk comparable to the market with better return and income characteristics relative to the market. So how does the strategy actually work? The point I really want to make here is that it's systematic and transparent. So every portfolio decision follows clearly defined rules, and we can tell you exactly why we hold every stock and exactly what drives its weight in the portfolio. The diagram on the right sets out our seven-step systematic process, and I'll walk you through it starting at the top and going clockwise. But the key point here is this is rules-based. There is no discretionary element from the investment manager as to what we think is going to happen in the future. What we're focused on is the academic data and research that underlines the investment strategy in this portfolio, taking into account those mispriced opportunities and letting that mispricing manifest itself in the portfolio over time, as you've seen through the results. But we start with the All Ordinaries Index. It's around 500 Australian listed companies. We deliberately use the All Ordinaries rather than the ASX 200 because it gives us access to high frank stocks that sit just outside the top 200 in the portfolio. I should say the portfolio, when it's developed, 85% of the portfolio is inside the ASX 200, with the 15% sitting just outside the ASX 200. And then we divide that universe into 22 cohorts. So we go to 11 industry groups, split above and below a market cap weighted benchmark that has been inflation adjusted since launch. And what happens is you end up with a grid of 22 buckets. So two buckets within each industry group. And that grid is what keeps the resulting portfolio close to industry neutral relative to the broader market. Again, we're not taking discretionary tilts as to whether we think one industry is going to outperform another in terms of delivering income or total return. We are focused on always remaining industry neutral relative to the benchmark. Again, the research will show you as soon as you introduce discretion into the portfolio formation process, it's likely that you are going to start underperforming relative to the benchmark. And as we saw earlier, very few managers can actually outperform relative to the benchmark. The next two steps pretty much form what we call the income engine for the portfolio. We look at the timing of upcoming dividends, prioritizing stocks expected to go ex-dividend over the near term. And then within that, we screen on net tax benefit. So for example, a stock must clear a minimum threshold of after-tax dividend benefit to be eligible. And we rank stocks within each industry and size cohort by that measure. And so the output is a portfolio tilted towards stocks delivering meaningful high franked income in the immediate window. This portfolio is full of companies that are profitable, paying high franked dividends. We don't have growth or speculative companies in this portfolio. And that is actually one of the reasons why the portfolio does not draw down as much in correction events. They are quality or value-based companies as opposed to speculative or, say, growth-focused businesses. And investors tend to tilt towards quality and value in times of drawdown. And then the rotational basis is what creates the faster recovery time. And then we go to a value to price step in the selection process. So for every stock, we compute a value to price ratio where value is the present value of projected dividends over an extended period using a set discount rate and an industry-specific long-term growth rate anchored to the RBA's nominal GDP forecast. And then we rank stocks by value within each industry with a screen that they must offer a minimum net tax benefit over the next 12 months. And that step in the process is really what um, is essentially stopping us or the investment process overpaying for yield. You don't want to overpay for income. Um, we're making sure that we're certainly not overpaying. And then, of course, the 45-day rule, it's an ATO requirement to capture the full franking benefit. We must hold a stock for at least 45 days around its ex-dividend date, and our trading is certainly built around that constraint. And finally, the fund rebalances every 2 months. So it doesn't turn over. We just adjust the stocks and the tilts in the portfolio or the weights. And it's adjustment, and it's not a complete turnover, as I mentioned. It's really with daily adjustments to handle applications and redemptions as well. Um, and then the result really is on the left. So currently 126 holdings, broadly diversified across the Australian equity market with market-like weights in all 11 industry sectors. And of course, independent governance through S&P Dow Jones indices. There's no leverage in this portfolio. There's no derivatives. It really is a clean, transparent, long-only equity strategy. Um, So really to pull the threads together, why is the fund different? First, high income with total return growth. Our systematic approach delivers high frank yield through disciplined diversification, as I've touched on, whilst being industry neutral relative to the benchmark for the reasons I mentioned earlier. Second, we are looking at investors' returns after tax. Ultimately, it's the after-tax returns that you as an investor keep. So the fund is specifically optimized for Australian resident investors or foreign investors who can take advantage of the franked dividends not being impacted by withholding tax. And frank credits are embedded in the portfolio construction. It's really not added as an afterthought. So at almost 100% franking, the distributions are among the most tax effective available. And third, this is evidence-based, as I mentioned. It's not prediction-based. This is a systematic rules-based process grounded in 25 years of evidence. Strategy behavior is explainable across market conditions. The result really is a fund designed to provide strong tax-effective income while maintaining broad exposure to the Australian equity market with total return growth. Where does this fit in a portfolio? We quite often get asked this, certainly by the advisory network. Our view is it sits as a core of your Australian equity allocation. And three things really make it suitable as a core holding rather than, say, a niche position. First, the market-like diversification. So somewhere between 110 to 130 holdings in the portfolio, with 85 inside the ASX 200, as I mentioned, 15 just outside, and an industry neutral approach. It very much behaves like the Australian market. But if you're already well diversified, um, you don't need to hold 200 stocks in an ASX 200 because what you are doing is you are giving up material tax benefits in the form of franking credits. The ASX 200 is only 80% franked. We're saying hold 130 companies close to 100% franked with the same spread of industry diversification and really sit that as a core holding in your portfolio. Second, it's systematic and transparent. So again, rules-based, fully disclosed process you can hold with confidence at the center of any allocation. And third, it delivers high tax effective income with total return growth. So we think it's an anchor holding, really not a side exposure. And around that core, you can obviously still hold satellites around active and whatever it is that you choose to invest in. One of the important characteristics of this portfolio is because it is systematic, it comes with certain behaviors. And one is, for example, as I mentioned around the drawdown characteristics, at some point the Australian market is going to have a correction. We don't know when that is. That's not our skill set. But understand with this strategy as a core Australian equity holding, you are well positioned for when that happens. Yes, you will draw down. Don't expect to draw down by as much. And again, you should expect to recover in a much shorter period of time. If you've got the ability to time the market, then that's a great skill set to have. We don't have that. But that may then determine whether or not you go into the strategy or you look at it as a core and tilt the strategy accordingly. One more piece of evidence we talk about is access. This is actually the cumulative net flows of the fund since inception. We don't mind showing this. Again, the fund's been around, it'll be 4 years in September. But 46 of the last 47 months have had positive net flows, and more than $13 million has come in over the past 10 months. That's not unusual for a fund as it's approaching its 3-year mark, but really those applications have come from high net worth investors, charitable foundations, and family offices with strong reinvestment and very few redemptions, actually. The single outflow month was a charitable disbursement that was later reinvested by that particular investor. So I show this because it tells you something a performance table cannot. Investors who already hold are reinvesting in the strategy, and new investors are coming on board as the performance and track record develop. So you can see here each month the net applications and redemptions, and really it tells a picture of investor appetite for this particular strategy. Fund details and fees. Applications are daily by 2 p.m., redemptions daily by 10 a.m. Distributions are quarterly. Minimum initial investment is $100,000 with minimum additional investments of $25,000. There's discretionary on that, particularly around reinvesting the franking credits. We have a management fee of 60 basis points, as I mentioned, and a performance fee that I touched on earlier. There is a buy-sell spread of 20 basis points in the fund as well. Actually, on that performance fee, that 15% of after-tax outperformance, that's charged quarterly and only on outperformance against the benchmark and only after any prior underperformance has been recovered since inception of the fund. And as I mentioned earlier, that can equate to an additional 30 basis points per annum if the fund is winning all of the time, which it doesn't. But you should expect this fund to outperform over any rolling 3-year period or longer. No entry or exit fees, daily liquidity, as I mentioned. So we see this as really quite simple, fair, and transparent in terms of the strategy. How to invest? The fund's available to wholesale investors only at this point with a minimum initial investment of 100,000, as I mentioned. If you would like to invest with the manager via our registry directly, you can request the information memorandum from us via the website. We're happy to meet or have a discussion and provide any additional materials you may need. And the application is completed online with Apex Group, who's our unit registry and administrator for the fund. Applications received before 2 p.m. on a business day are processed the following business day, and our team can certainly help at each step of that application process. For advisors on platform availability, the fund is on Netwealth in the private menu. So speak to your BDM about switching it on for access. It's fully available on Morgans Financial Wealth Plus for immediate implementation if you'd like to access. And Hub24 onboarding is in progress right now. So all of that documentation is with Hub24. But if you've got demand via Hub24, then please certainly let us know. So to close, really, we believe investors deserve high tax-effective income with total return growth. This is a systematic evidence-based process without emotional bias or style drift, full transparency about what we hold and why, and aligned interest through co-founder co-investment. Again, I mentioned we're all co-invested in the fund. Excuse me. So we're certainly open for an investment right now, and please visit the website if you'd like further detail. We will circulate these slides following the presentation along with the recording. So again, you can just reply to that email with any questions you might have. So that's the main presentation. Let's just go to questions. I'm just going to pull up the question panel. Got the first question here. Can you explain franking credits to me? Yes, I can, and it's a good question. In fact, I think there's something here in the appendix about this. We do often get this question. Franking credits are really quite a unique system to the Australian equity market. In fact, as far as we understand, the only other country that has a franking credit system is Malta. Um, but really, the system was introduced in 1999 and later developed a few years later through John Howard. But if you can think of corporate tax as a prepayment of personal tax, it really is as simple as that. And so, what that means is if the company is declaring $1 of profit, they will pay 70 cents to the investor as a fully franked dividend, assuming it's an Australian company that's derived all of those profits in Australia. And they'll pay 30 cents to the ATO by way of corporate tax. Now, if you are a tax exempt investor, if you're a charity or a retiree on a 0% tax rate, you actually get that 30 cents back from the ATO, assuming that the dividend was fully franked. In your superannuation fund, if you're in accumulation phase at 15% on income, you'll get half of that 30% back. If you're investing via a corporate entity, that 70 cents to you won't be taxed at all because it's already been taxed at the company level. And if you're a high marginal tax rate investor, including the Medicare levy at 47%, rather than being taxed at 47% on that 70 cents, you're only going to be taxed at 17%. So the 47 less the 30% that's already been paid. And that is unique to Australian equities and currently hybrids at the moment, which are being phased out. But Australian equities, it's a really unique tax efficient way that stops double taxation, certainly at the investor level. There's a chart here in the deck which explains the different return types and the tax effectiveness. But as you can see in that deck there, tax effective income really is the most effective income you can receive. Why does the portfolio hold so many stocks? 130 stocks seems like a lot. Actually, I just flicked on a slide in the appendix. We've got a chart on this which explains why diversification is incredibly important and why predicting winners or why active managers with concentrated portfolios tend to underperform the market. And this is just one reason. But what you can see here, this is actually showing you, this is a US example. Australia ASX 200 or 300 is very similar. We just found this data on S&P, but this will show you the returns of the S&P 500 over the last 25 years. And what you can see on the bottom axis there is the percentage return that a particular stock in the S&P 500 returned over that 25-year period. And the frequency is the number of stocks. The y-axis is the number of stocks in the S&P 500 that returned that particular band. And so what you can see there is the market or the S&P 500 over that 25-year period returned 452% as a market. But the middle stock or within the 500 only returned 59%. So what that means is only the stocks to the right of the red line or the average, they're the stocks that outperform the market, which on this chart I think is roughly about 18 to 20% of the total constituents in the S&P 500. Now, if you are holding a concentrated portfolio, you need to ensure that you are holding the right stocks at the right weights at the right time. And some managers can do that very well, most can't. That's certainly, again, not our skill set. But what we are doing is by holding a higher number of stocks, you are reducing the concentration risk and what's called the forward or positive skewness risk as it relates to your portfolio. So again, we would say hold about 110 to 130 stocks paying high frank dividends. You don't need to hold 200 if you're already well diversified. You're effectively going to get market returns. If you want to outperform, certainly on an after-tax basis, hold 110 to 130, but focus on companies paying high frank dividend yields and be diversified with the same industry weights as as the broader market. How big can the portfolio be before the strategy stops working? Good question. As I mentioned, it's only over 40 million at the moment, which is not unusual for a fund that's going through its validation period, but just coming out of the 3 years. The portfolio capacity is actually 2.5 billion. And really the reason for that is 85% of the portfolio, as I mentioned, sits inside the ASX 200, with the remaining just outside it. So it is a portfolio of liquid companies. So the capacity is much larger than where the fund is today. How would I fund this in a client portfolio? What does it replace? Oh, look, just as I mentioned earlier, we would suggest it sits as a core Australian equity holding in your portfolio, again, for the risk-like characteristics that I mentioned. So the diversification, the industry neutrality of the portfolio relative to the market, but also the drawdown characteristics, which are important, as I mentioned earlier. Again, we don't have the skill set to know when the market will correct, but just know that if this is a core holding in your equity component of your portfolio, you are really well positioned because it will draw down, yes, but they are quality companies. They are profitable companies paying high frank dividends, and the recovery period because of the rotational basis is much faster or quicker rather than what you would see relative to the market. I am already in an equity income fund. How does yours compare? The main differentiation, actually, I've got a slide on this too. The main differentiation I would say is um, it is income not at the expense of growth. This chart here, we produce this every 6 months. This is actually showing you all of the Australian equity income options that were available at the end of December last year. The bubble represents the size of the fund. Each bubble is a fund. And what you can see on the bottom there, the bottom axis is the annual return over the last 3 years. And the y-axis is the income that was returned over the last 12 months. The crosshairs there is the S&P ASX 200. So, for example, the S&P ASX 200 over that period returned just under 13% per annum with a dividend yield of say, call it just under 5%. Now, what you can see here is that most of the funds represented by the bubbles are actually in the top left quartile. So what that means is those funds are producing higher yield or income than the market, which is great, but that is being produced at the expense of total returns. Um, you're just as better off being in an ASX 200 ETF. Lower fees. Yes, the yield will be lower, but that is not coming at the expense of total returns. Where you want to be as a strategy, and you can see where the fund is, you want to be on the top right quartile. Look, whether it's you just want to be in there somewhere. Now, our fund obviously is producing a higher yield and doing pretty good on a total return basis relative to the other funds. And that's where the strategy sits, again, being systematic. The funds that are in that top right quartile tend to be systematic funds, and they tend to be really well diversified funds, not concentrated funds. Again, for the reasons as I just mentioned. And that's the 10-year performance. So that's our fund represented by our proprietary index, less 1% per annum to account for fees and any price impact and transaction costs. So it just really just a proxy relative to to the fund. And again, you can see there it really is a standout in terms of the strategy producing high yield and not at the expense of total returns. What happens when a company in the portfolio cuts its dividend? But the rules handle it at the next rebalance rather than us reacting on a day. Again, there's no discretionary overlay. A cut would reduce the stock's net tax benefit, so it screens out or drops in weight mechanically in the portfolio. And that's the trade-off with systematic process. There's no panic and certainly no discretion as far as the process is concerned. What's the strongest argument against investing? Good question. Look, these are shares. This is what I call equity risk. So it does come with volatility. Again, it's got the same volatility characteristics as buying an ASX 200 ETF. But in an event of a drawdown, as I've mentioned a few times on this call, it won't draw down by as much, and it will certainly recover we would say a faster period of time, which makes it a really neat core Australian equity holding for any portfolio. And one more, if someone wants to move on this, what's the actual next step? Look, talk to your advisor if you're advised. They can assess the suitability and complete the application for you. Again, if you're unadvised or self-directed, we would certainly encourage you to contact us via the website and request the information memorandum and review that. And of course, you are welcome to talk to any of the members of the team to discuss the strategy. Applications go directly to the fund's administrator, Apex Group, if they're there daily before 2 p.m. And the next distributions I mentioned is in October for the fund, which are quarterly. And our details are on the closing slide as well. One more question which has just popped up. Can you touch on the business part? Look, so the business partners for the fund. Again, I should have touched on this earlier. The fund or the business, we set this up institutionally from day one when we started the fund. So we have an independent trustee in K2 Asset Management, which is, we think, very important. The trustee is what holds the investment manager to account across governance and compliance. Where you can find an investment manager with an independent trustee, we think that works really well. You want someone independent overlooking the manager to make sure that they are doing all of the things that they're supposed to be doing from a regulatory perspective. Our administrator, custody, and the registry team, that's Apex Group. That is a large global fund administration business. They handle the applications, redemptions, all of the accounting and reporting for the fund. We don't handle the application funds. That's all done through Apex. And you'll see it in the information memorandum. We are really just appointed as the investment manager for the strategy. The distribution's audited through KPMG, and obviously there's legal advice and transaction and trading costs, but these are all institutional grade business partners for the fund. I think that might be it for the questions. Look, I think we're a little bit over time. I appreciate you dialing in. Thanks very much. There are some additional slides in the appendix. If you'd like to look at those, we will include those when we circulate the pack. But again, if you have any questions in relation to the strategy, even feedback on today's presentation, we'd appreciate that too. Please reply to the email or contact us via the website, and we'll certainly look forward to receiving those inquiries and questions from you. But with that, I'll wrap it up there. Thanks very much, and hopefully we'll see you again soon. Thank you. Bye.